this morning I want to talk about the effective Fed funds rate. And I want to address the mystery of why it is that the RBA decided to increase rates not to 25 basis points, not to 50 basis points, but to 35 basis points. How did they get that number of 35 basis points? Where did it come from? Where it came from was that the RBA, in the person of Mr. Philip Lowe, PhD, is now following, moving the Australian cash rate to follow the effective Fed funds rate. So the Fed funds rate is the rate at which banks can borrow from the Fed. That's the simplest way to put it. There's a vastly more complicated a description of it on the in the website of the New York Federal Reserve, but that's the simple way to understand it. And US banks borrow from the Fed, can borrow from the Fed on any day. And the overnight, the New York Fed, which handles all of the transactions for the Federal Reserve, calculates what those cost of funds are, and it actually publishes a thing at 9 a.m. every morning showing the probability distribution of those borrowings, and it does the median, calculates the median, and that's published as the effective Fed funds rate, the rate in which US banks are actually borrowing from the Fed. And where that effective Fed funds rate usually settles is about 8 basis points above the lower bound set by the Fed. So if the Fed is setting a bound of between 0 and 25 basis points, that will result in an effective Fed funds rate of 8 basis points. And in the situation that occurred last year, when the Fed funds rate was, for quite a while actually, between 0 and 25 basis points, that effective Fed funds rate of 8 basis points led Mr. Philip Lowe, PhD, to reduce the Australian cash rate to 10 basis points. So that 10 basis points was matching the US Fed 8 basis points. Now, what happened at the beginning of this year was that the Fed, in its first increase, put up rates to the band 25 basis points to 50 basis points, and that resulted in an effective Fed funds rate 8 basis points higher than that 25, which meant 33 basis points. And these numbers are available on the New York Fed website. And to match that 33 basis points of the effective Fed funds rate, the RBA has now put up the Australian cash rate to 35 basis points, which is as close as we're going to get. Okay, so where is that? Where do we think that rates are going to go now? About 10 days ago, maybe a little bit longer, actually, I think it was about 12 days ago, before the RBA meeting and before the Fed meeting last week, I attended a webinar by Mary Daly. Mary Daly is the president of the San Francisco Fed. Now, I've seen Mary Daly speak in person on at least twice, and on both occasions, she's an amazing person in a public presentation because she's no more than 5 foot tall, and when she stands up behind the lectern, it's only her head which is over the top. But as soon as she begins to speak, she totally dominates the room. Incredibly powerful speaker. And I think she'd be a really good candidate for the person to follow Jay Powell as chair of the Fed. I mean, she's just enormous background, macroeconomics and labour economics, terrifically powerful mind. And what she said was, this webinar a dozen days ago, was that she thought what the Fed should do is move to the long-term neutral rate. Now, the long-term neutral rate was published by the in the summary of economic projections by the Fed after the February meeting. And in the summary of economic projections, all the Fed presidents and the members of the Open Market Committee suggested that they thought the long-term equilibrium for the Fed funds rate was 250 basis points. And that 250 basis points would be the equilibrium long-term level if you had 4% unemployment and 2% inflation. So what Mary Daly is suggesting, and what she said immediately after that, talking about that, was that she thinks that the Fed should get to 250 basis points as rapidly as it can, and she thinks that it should do that in 50-point leaps. Okay, so that's the scenario we're working from today, and what we think the Fed is the scenario that the Fed has in front of it about what it's going to do. Now, what in fact Jay Powell said in the press conference after he put out the release last week was that he thought that there would now be a couple of additional 50-point rate hikes, and then the Fed would look at what the situation was. So I think Jay Powell is operating within this general scenario of 250 basis points by the end of the year. Okay, so where does that therefore take Mr. Philip Lowe, PhD, and what he's doing with the Australian cash rate? Well, given that the Fed has already moved its band to up to 75 basis points to 100 basis points, that has resulted in an effective Fed funds rate 8 basis points below the lower bound, which means that if you look on the website of the Federal Reserve Bank of New York and you ask the question effective funds rate, it will show you a chart and it will show you a table which says the effective funds rate is now 83 basis points. Okay? And given that the RBA is following that, I would expect that at the next meeting, the next monthly meeting of the RBA will put up rates by 50 basis points to 85 basis points. Bang. Okay. So the meeting after that, now the Fed only meets every 6 weeks, not every month. So our rates increases, I think, will follow what the Fed has done the previous month. So in 6 weeks' time, the Fed will meet again, and when they meet again, they will put up rates from 83 basis points to 133 basis points. And I believe the RBA at the meeting after that will increase our cash rate to 135 basis points. So we'll follow up the Fed, but we'll follow up to the effective funds rate. So we'll have a ladder, not 25, 50, 75, but numbers which go up just a couple of points more than the effective funds rate. Where do we get to at the end of the year? Let's assume that Mary Daly is right. And let's assume that the lower bound of the Fed funds rate by the end of this year is 250 basis points. That is to say, the band will be between 250 basis points and 275. And that means that our cash rate by the end of the year, if we continue to follow the Fed in this fashion, is 260 basis points. Okay, so that's the effective funds rate. The effective funds rate, Fed funds rate, is the volume median of overnight Fed transactions and banks borrowing from the Fed, but it also has an implication for us because we are now following that in setting our cash rate. Of course, the Fed just doesn't set short rates. It also provides forward guidance. And the forward guidance of the Fed is what I've just been talking about now, what Mary Daly is doing about where she thinks that the Fed funds will be by the end of the year. And that's within the area of what's forward guidance. And forward guidance has an enormous impact on the bond market. And I've talked before about how the really powerful things that the Fed does is not just moving rates at the short end, but its influence on moving up the long end. So what we've had as a result of this forward guidance since the Fed meeting is we've had a very dramatic sell-off in in US 10-year bonds and therefore Australian 10-year bonds. Okay. And that has generated, and very considerable downward pressure on equities. So what that does, because bond yields are in our models, both of the ASX 200 and the S&P 500, that now pushes down a bit more, puts downwards pressure on our fair value for both of those markets. So today, the fair value for the ASX 200 is back at 7,200, 7,207, based on current bond yields and the increase in bond yields that we've had. It's gone from, what that fair value has done is it's gone from 7,200 about 6 months ago all the way up to 7,600, from 7,200 about 6 months ago all the way up to 7,600 after the last earnings season, and now the increase in bond yield has pushed it down to 7,200. At the same time, fair value for the S&P 500 is now 4,050 points. So what is happening is bond yields are going up, and that is reducing fair value in those markets, and both of those markets have been falling down towards pretty close to fair value and perhaps starting to fall below that fair value right now. Are there any questions?
Is that valuation based on 2.6% or on where it is right now?
My valuation is based on where bond yields are right now, rather than my 2.6%. It's kind of pretty interesting that bonds, I ran my bond models this morning, and US Treasury bonds, in terms of my bond models, have been overvalued for about 5 years, and they were the most overvalued in the history of the model in 2020, and they're now really approaching fair value. So I've got a fair value for US bonds about 3.2, and Australian fair value about 3.5. And we're selling a pretty, this is the first time this is the closest we've been to fair value in years in terms of our long-term bond market.
And the jumps that they're doing, is that enough, in your view, to get inflation under control? Are they going too quick, are they going too slow, or they're just about right?
Well, it's pretty interesting, because what the Fed outlook is that inflation, and the RBA outlook too, by the way, is that inflation goes up at the end of this year and then goes down in following years. Now, that suggests that the yield curve, well, it continued. I'll just talk at you, I guess. The yield, that short rates will actually rise faster than long rates, okay? Because at some stage, for that to happen, the yield curve has to invert for inflation to actually fall like that. And I think the yield curve will invert in about 23, and I think that generates a slowdown in 24 in the US economy and ours, but not yet. I think they'll be putting up rates and slowing the economy, and I think they'll get inflation under control. I really don't think that the inflation is going to get away from for the Fed, and it's certainly not going to get away from the RBA. And the reason for that is that this is not, even though people talk as if this is stagflation like the 1970s. In the 1970s, there was a huge flood of international reserve assets and international reserve inflation, and that's just not happening. So I think this is a short-term surge in inflation, and I think both the Fed and the RBA will get it under control.
What does it mean for your Aussie US dollar currency valuation, the model?
Well, the Aussie dollar has been extremely cheap in terms of our model all year. But the money's flooding. My big surprise in terms of the outlook for the Aussie dollar is that the euro area didn't put up interest rates, in spite of the fact that they have inflation every bit as high as the US. In the previous cycle, they would have done that. Why didn't they do that? Well, they didn't do that because of the war. So the war has generated a flood of funds into the US dollar. The Aussie dollar is deeply, deeply undervalued based on current commodity prices and current interest rates. But we're getting the benefit of that in fantastic earnings from mining companies. The US dollar must rise, the Aussie dollar must turn around and rise, but it's so far stubbornly refused to do so.
Knox, he goes...
Michael, what about quantitative tightening and the influence that it will have on real demand, and how do you capture that in your valuations, and then also the mass pull forward of consumption in economies like the US, UK, and even here?
The problem with quantitative tightening is there is no accepted way of dealing with it in economics. There is an approach that Jay Powell is using by individual event studies. That is to say, any time there's an announcement of quantitative easing, what seems to happen is bond yields seem to fall 25 basis points. And so what Jay Powell thinks is that, and he said this when he was asked the question precisely about this in the press conference after the last Fed meeting, was that he thought that the effect of quantitative tightening on rates was pretty small, and he thought it would only effectively add about 25 basis points to rates. Now, I think that's just wrong because they're selling about 4.6% of GDP on an annual basis of assets from the Fed balance sheet. But I don't know any better than them how to calculate it. The problem is because there's no agreed way in economics to calculate it. But I suspect that it will have I think it will have a very powerful effect, and that the result of that is that interest rates won't have to go up as far as the market might think, and bond yields won't go up as far as the market might think. But we start running down the Fed balance sheet in June, and it'll be really, really interesting to see what happens over the next couple of months. I think it will have the effect of slowing demand in the US economy at a faster rate than is currently believed. Because what actually happens when you sell those assets, the people who buy those assets, or the institutions that buy those assets, are US commercial banks. And because they're buying US securities, they're not buying business debt anymore. So the buying of those bonds by banks reduces the amount of business lending, that reduces the amount of investment, and that slows the US economy. So that's why I think it will be much more powerful than the Fed thinks. But we have to see the numbers to calculate what exactly the size of that is.
Michael, probably just one last one. I suppose those kind of aggressive moves by the RBA seem to mean that they're sort of behind the curve. I think it was in October last year they were talking about no rate rises until 2024, and I assume a whole bunch of people levered right up on the property cycle. If rates do go up, let's just say 150 basis points, that's a big hit to I suppose most people's mortgage payments. Are they? Is that a risk for the RBA? Have they commented on that?
The first part of the question, I don't believe the RBA is behind the curve. I think that the curve is their expectations of future inflation. And as I've previously said, and I said last week, I think what happened was their forecast for future inflation in February was that the Australian core inflation rate would be 2.7% by the end of the year. And now in the release of the quarterly statement on monetary policy, which was only released after the RBA meeting, that forecast has now gone up to 4.75% for core inflation in Australia at the end of this year. So they're in line with that curve of future inflationary expectations, and they've decided to move on that. What the impact of that is? Well, notionally, what is said is that banks in their lending have been required to include an additional 3% margin for the cost of loans before they've been able to approve loans. So if that's the case, then banks have provided enough margin, calculated the margin of a 3% increase, which gives borrowers a cushion, so in which the bank's view is that the people who borrowed money from them can absorb a 3% increase in rates, because that's the conditions under which the banks in this cycle have provided the loans, new loans to consumers. So it'll be a great test of the theory about the effectiveness of that 3% margin. We're about to find out.